Exciting day in the markets today. You've been watching the news. They were meeting out at Jackson Hole, they being the Federal Reserve Board, and giving every indication that they're going to start lowering rates. So we'll talk more about that. Important disclosures here. I'm using a lot of this information coming from Morningstar. They've been a partner of ours for a long, long time, like 30 years, as far as I can back as I can remember doing this. But for some of you, if you, last week we had a charcuterie class, and in the back of the room we have a charcuterie grazing, what they call a grazing table. So I thought I would just give you a quick reminder look of this, since if you didn't make it, you can see what kind of grazing table we had at our charcuterie class here. Just kind of keeps going on and on and on, and it was incredible. And this is our second year to do this, and it's been really popular. So I guess we'll just continue doing it, but I think we probably need more than one grazing table, because here's what happened to the grazing table after. Oh, that still hasn't been grazed. That's been grazed. So there we go. There's the after. This is after it's been grazed. So I guess about 40 people grazed on that. Some people grazed more than once. So that was a lot of fun. But finally, now we can jump into the stock marketing. And, we had COVID, and everybody can remember that, although I think we're all trying to forget about it. And then they printed a lot of money, and then we had massive inflation. And so right around in here, they started, raising rates or whatever. We had a big drop in 2022. And it really took all of 2023 just to kind of get back to where we were at the end of 2021. So from 2022 all the way basically to the beginning of this year, we just had one big round trip. Now, since January of this year, it's been pretty much gangbusters, especially in the tech area. So we also can look and see that basically earnings have been driving stocks, as they often do. So you can see we've going all the way back to COVID again, and then we had our drop here in 2022, and then still we have our earnings. 70% of our earnings of our corporations come from consumer consumption. So consumer consumption is sort of it's kind of a cyclical thing, because it's a lagging indicator, because people consume more and spend more when they feel good about things, and they feel like they have a lot of money in their 401k plan or other things. So when the market is down, people feel bad. So it's almost like, okay, well, we need them to feel good so the market will do well. And then if they feel bad, the market doesn't do well, and then they feel worse, and so it doesn't do well. And it's kind of a cyclical thing. But right now, everybody is pretty happy, especially after today and after the announcement that Fed Powell gave just a little while ago that says that, we're getting ready to make some changes. And everyone knows that's code for we're going to be dropping interest rates. And the majority of our growth in the stock market has been driven by growth. Value stocks, if you remember the difference, value stocks, it has to do with what they do with their profits. So like Georgia Power, for instance, or Southern Company, when they have profits, they pay those out in terms of dividends, and that's what we call value. A value stock doesn't mean they're a good value necessarily. They might be a bad value. They just are paying out dividends. So value stocks pay out dividends. Growth stocks, a lot like Microsoft or like Nvidia or a lot of these tech companies, they're not paying out dividends. They're taking their profits and reinvesting those in research and development, and coming out with the fastest gigabyte of technology. But certainly we've seen where growth has been driving the growth. But you can see also in 2022 that was where a lot of the drop came, and I think that's also where we're going to be seeing in the future that sector is really getting volatile, and we see it all the time. And if you look at the FANGs, these few stocks here, which are very highly involved in AI, and of course you can add Nvidia to that. You can see here's the S&P 500 down here in the red. That's the other stocks that are not involved in the AI. And then here are the tech stocks that have really soared. And I got to tell you, it looks so much like 1999. It looks so much like the dot-com boom and subsequent bust that it almost is playing out exactly the same. And remember, if you go back and you remember, it's not that we had the dot-com bust. It's not that the dot-com bust went away or the dot-coms went away or the internet went away. A lot of companies did go belly up, but a lot of them are around and they're better than ever. So, when we have these retrenchments or we have a market decline or we even go into a recession, it's not like everything is going to go away. It's a lot of things will come back. So AI is definitely here to stay. It's just that there may be a lot more excitement about it right now than is warranted, let's just say, a lot like the internet was in 1999. And we can see, volatility has been relatively low. I mean, of course, COVID-19 was the major volatile moment. But since then, volatility has been relatively low. And then really since the beginning of 2024 this year, we haven't had much volatility at all until we did, and that was on August 5th. Now, all the charts that I've shown you up until now are up, end up at the July 31st. So that's up until the end of July. So really, it wasn't just a few days later until August 5th that we had another massive volatile index, and this is the largest, highest peak that we saw in the volatility fear gauge since the pandemic. So ask people, well, where did this happen? Why did this happen? Well, essentially, it started off in Japan, and it essentially was what we call the end of what they call the carry trade. So Japan has historically, at least for the last 20 years or so, had lower rates than anybody else pretty much on the planet. So as far as a major economy, so you could go over to Japan and borrow, $1 billion for maybe 2%, and then bring it over here to the United States and then buy treasuries at 5.3, let's say, and then you could just arbitrage the difference. As long as those rates, carried that difference there, you were okay. But you also had to watch out for the exchange rate because that made differences too. So you got the exchange rate going on, as long as that's a status quo and the interest rates are a status quo, you can make a lot of money doing that. The problem is Japan started raising interest rates, and they only raised it by a quarter of a point. But when they did raise it a quarter of a point, people see, oh, now they're moving in that direction. So my arbitrage is not going to work. Not only that, they're raising interest rates in Japan, which is going to make the yen stronger against other currencies. So I might lose my my differences in the currencies there, the fluctuations in the currency. So we can see that in the Japanese stock exchange, the Nikkei, August 5th, just about 15 days ago, was their biggest drop ever. The biggest drop, the biggest single day drop in the history of Japan, at least in modern times, was then, and that was obviously an increase in volatility around the world. So it happened here in the United States. The Dow saw a big sell-off. The S&P saw a big sell-off. We were around 5650 and came down to 5200 roughly. The NASDAQ was off the most. And again, because this is also, the one that's most overbought, let's just say, this particular sector. But I thought this was a good quote because it's good to remind us all of how fast this can turn, because markets have a tendency to go up in a stair-step fashion, step, 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 and then maybe take a step back, keep going up. But when they drop, and they drop significantly, I mean, it's like they're falling out of a window. So you can see we had a 1,100 point drop in one day in the Dow Jones on August 5th. And that is a large drop to have in one day. So you can see, like today, we're up about, already 330 points. But because that's the good news that we have already kind of baked in, we're already expecting them to drop rates at the end of September at their next meeting. So certainly, if he had said something like, "Oh, the rate drop is off," then we would be having a really, really bad day. But you see, what happens here is, instead of us talking about dividends and interest and profits and earnings and all those things, we're completely focused on what the Federal Reserve is doing with interest rates. Are they going to lower it? They're going to raise it? They're going to keep it the same? And the markets are moving based on that. And I know that it goes deeper than that. And here's why. But these are the things that we're concerned about, and one of them is high interest rates, which is obviously the big concern among everyone. And one of the reasons for that is the corporate debt, which I'll show you in a second. Um, but the other concern that we look at is the unwinding of the balance sheet. I'll talk about that. But the balance sheet of the Federal Reserve, which is basically new money that's newly injected, newly created. So it works both ways, and we'll talk more about that. Leading indicators, that's something that we're looking at strongly, which is still negative. And all these things are still negative, even though we're having a very positive day today. This doesn't wipe away all these problems, doesn't wipe away all this debt, and doesn't wipe away the price earnings ratios that are way over above where they should be. And it doesn't fill this commercial office space that's empty. If you look at our office building, I mean, we're changing into assisted living because we really don't have any tenants to speak of. I think we and maybe one other group on the 5th floor are the only ones here. Oh, there's somebody down on the 3rd floor. So interest rates, I mean, you can see what happens, and this happens all the time as interest rates go up, we plateau, we have a recession, and then we drop interest rates back down to the bottom, or at least the most recent bottom. And then things start looking better, inflation picks up a little bit, then we start stair-stepping our way back up, then we plateau, and then interest rates drop, we drop interest rates, the stock market starts dropping, and then we have a recession. So even incidentally, going back to this 2008 crash here, they started dropping rates before the market started dropping. So, our market is volatile, but not dropping, and we're not necessarily in bear territory, but neither were they in 2007 when they started dropping rates. They started dropping rates before the market stopped. And when they started dropping rates, the market went up a little bit, but then it turned around and then it was just collapsed. And then that's when they ended up having to go all the way down practically to zero. And then we enjoyed that for a good long while. And then we were starting to raise rates again because we felt, some inflation, not too bad, but some. And then we had COVID. And then once we had COVID, we just tripled the money supply practically. And now that's why everything costs so much. And then across the planet, with us and China, China too, and the European community, and also with Great Britain, and also with all these other countries, we've pretty much been raising rates at lockstep together. So in just to put that in perspective, I was at the grocery store every once in a while. I don't go that often, but I was at the grocery store the other day, and I just passed by this display that had these donuts on there. And you may see that these are Krispy Kreme donuts. And, I've been eating Krispy Kreme donuts ever since I was a kid. Obviously, you can see I've eaten too many, and I really don't eat them anymore. But sometimes I'd like to. But it struck me because I was walking by these and I saw 12 just regular gray glazed Krispy Kreme donuts. And I couldn't believe what I saw, because here's the price of those 12 donuts. Now, you grew up with these same Krispy Kreme donuts, and you were probably a kid. You may remember how much your mother, father, or grandmother paid for them when you were growing up. For me, it seemed like it was $3.99. It sort of stuck in my head, or maybe $4.99 or something like that. But now it's a whopping $14. So over $14 for these 12 Krispy Kreme donuts that are not hot. They're just, in the box in the grocery store like you would normally find. And that's just incredible. I just don't see how, especially the lower class or people on fixed income are going to be able to survive this, because even though they say inflation is going down, that just means the rate of inflation is slowing. It doesn't mean things are getting cheaper. Things are still getting more expensive. They're just getting more expensive slower, if that makes any sense. So next year, these Krispy Kremes will be more than this. They may be $15.29, but that's better than being $18.29, and that's what the Fed is saying right now. So it's not like prices are going to come down. And the gas prices have been artificially depressed because of the strategic reserves that they're emptying. We're about half empty now in the strategic reserves. So the federal funds limit, remember the rate, they were telling us, okay, we're going to plateau, and in 2024, we're to come down. 2025, we're going to be way down here by 4%. Well, that never happened. And so We're just now learning today that almost certainly we'll be dropping rates in September. And then now the big question is, well, how much is that going to be? Is that going to be a quarter of a point? Is that going to be a half a point? Well, chances are very good it's going to be a quarter of a point. That's most likely what they're going to do. We can see the rate hike cycle. This has been current cycle that we're in. This shows the depth of the cycle and the length of the cycle. And this one here, this blue one that went seemed to go forever, that was in 1977. And this deep one here that really went straight up, that was Volcker during the early 80s. That was 1980. So we're kind of halfway in the middle of those in terms of steepness and in terms of depth. So we'll continue to see how this goes, but I would expect that this cycle is starting to wind down. And we'll have to see how quickly it winds down, because if we have a major drop in the markets, as we do expect sooner or later, then they're going to drop rates quicker than they are currently expecting. And then we can see this is happening with us, this is happening with the Bank of England, this is happening with the European Central Bank, and then as we discovered very rudely on August 5th, it's also happening now with Japan. So, and again, one of the problems with that, with raising rates and rising rates is the debt that if you're holding debt and you have this debt service, and a lot of the corporate debt is mostly in 5-year bonds, but these 5-year bonds that they're holding are maturing every quarter. So they're maturing in tranches. They don't mature once. They mature in tranches. So as these new bonds mature, this new debt matures, they have to reinvest it. They have to, roll it over into a new tranche of bonds, and those new bonds are now at triple the rates. So that's the key problem with having a lot of debt and interest rates going up. It seems like it's very commonsensical, but because of the way that debt is structured in corporate America, it's through these bonds, and they roll over into new higher issues, and the higher issues are now like twice or usually 3 times as much the interest or the debt service that they're having to pay. And that cuts right into the bottom line. That cuts right into the profits of a company, and that cuts right into the earnings of the company. And then one of the things that we look at is the price earnings ratio. What are the earnings of a corporation, and does the price of that company justify the earnings that they are that they're earning or not earning? So that's the problem with corporate debt. The other problem is the balance sheet. So this is a good thing and a bad thing. We definitely want the balance sheets to come down. Okay, absolutely. Because what balance sheets are, that's a representation of why we're having all this inflation. The corporate or the global central banks, when they expand their balance sheet, that means they're just creating new money, just out of nothing. Okay, just created new money out of nothing. That new money goes over to the Treasury, and then the Treasury sends it out. Okay, they did that in 2008, but with the global financial crisis, we had quantitative easing 1, QE1, QE2. I can't even believe, I remember looking back at QE1 thinking that was outrageously huge. And now you look back at QE1 and it's just like the little blip that we just got started on, because we were looking at maybe a few $billion there. No, we were a couple $1 trillion. Well, now we're at over 7 trillion of money. This is newly created money that just came out of nowhere, and then got into the system. And this is why the donuts cost $14, because you have so much more money in the economy. And we probably could have gotten by okay, because we were trying to come down and reduce our balance sheets here before COVID, but then COVID hit, and then just all bets are off, and then we just went through the roof. So we were showing some inflation, and we were trying to reduce that, and then COVID hit, and then it was just triple the money slide, boom, boom, boom. So look at that. And then since then, we have reduced the money supply, we have reduced the balance sheet. Which is good. We need to continue to reduce this all the way down to nothing. Okay, because then that would leave us with our dollars being stronger, the ones that we actually work for, the ones we pay taxes on, the ones that we risk in the stock market, and the ones that we walk around in our pockets with, which we do less and less. It's just credit cards these days. But then there's also these other things called leading indicators. So if you look at a leading indicator, it's think of yourself as a builder. You're going to build a neighborhood, and you've got 10 acres, and you're going to build a neighborhood. The first thing you have to do before you do anything is what? You gotta go get a permit, a building permit, and then maybe you have to get a surveyor. Okay, well, both of those things. Oh, you're doing surveying. You're thinking you're maybe doing something. You're going to be doing something in the future. You're getting a permit. You're going to be doing something in the future. So those are leading indicators. If you're out shopping, you know, because you feel good, because your 401k is high, well, that's a lagging indicator. That tells us nothing about the future. It only tells us how you feel today because of how the 401k has performed in the past. There's nothing about the future, okay? It does mean, hey, good, you're spending money, so then maybe the earnings next quarter will look good, and that's can be leading, okay? But when people feel good, it just means that in the past, it's been good. In the future, we want to look to these leading indicators, that the future instances where we have an idea. Okay, well, a shopping center is going to be going in here, a new subdivision is going to be going in here, a new Starbucks is going to be going over here right next to a Waffle House. So those are the kinds of things that are leading indicators. And if you can see, in every single instance since 1970, where we have had strong leading indicators like we do today, we've had a recession 100% of the time. Okay, so we go back to the 70s, we had a recession there. If you go back into, well, the mid 70s, another recession. That was the stagflation that we had under Carter. It's kind of where we're headed, I think. 1980, in the 80s and 1990s and 1987, remember that? And then again, the tech bubble. That was a lot what it looks like today. The global financial crisis, remember, that originated in the banking sector because of all the credit default swaps. Okay, well, that's completely different than where we are today. Today, we're in the tech sector, and that looks a lot like it did back in 1999 when we had, the internet thing. The internet's still here today. It's better than ever. AI is going to be around forever, but it just may be right now a little over excitement, because we have these fads that we go through, and that's just kind of how we are as a culture. COVID obviously was a serious leading economic negative indicator, and then here we are again today with those negative indicators. The other thing that we look at are stock prices. So again, looking at history, it's the only thing that we can really go by is take a look at, the last 100 years and what has happened in the last 100 years, and then how we compare that today. Well, we can look at the ranges of stock prices over the last 100 years based on different things. Like, for instance, price to earnings ratios, price to book. What is the price of a stock vis-a-vis the book value that we have on our books, or the accountants have on their books? What about sales? How do our sales? Because sales and earnings can be different. Remember, if we've got sales up here, but we've got a whole lot of debt service, well, our earnings can be down here. If our debt service is low, then our earnings are going to be closer to our sales, and that's close with what we want. Debt is not good, as you intuitively know, but corporate America loves debt. If you have a corporation, they're going to require that you go out and float some bonds, because that's just what you have to do. So you can see that in these boxes here, that's the range of the prices of stocks vis-a-vis each of these different categories. So for price to earnings ratio, this is the range that stocks generally fall into. Now we're a deviation above that, 2 deviations almost above that. So the red dots are where prices were last year. Okay, the blue dots are where prices are this year. And this is up to July 31st. So since July 31st, I'm sure things have changed, but after today, we're probably right back where we were. So in every single category, price to book, price to earnings, price to sales, price to cash flow, dividend yield, in every single situation, no matter how you slice it, stocks are overpriced. And I know it, you know it, Warren Buffett knows it, but somebody out there is buying today. They don't know it. And I think that's a lot of people with those 401k plans, or a lot of that generation that maybe they were in high school in 2008 and just don't remember this. And they certainly don't remember the dot-com bust, but they heard about it, I'm sure. The other problem that we're looking at, last but not least, maybe, is this commercial real estate. Commercial real estate, again, if you look at our building, it's probably, I would say, 35% occupied. That doesn't mean that leases aren't being paid, rent's still being paid, I'm sure, but as these leases roll off the books, they're not going to get renewed. and they have already they haven't officially put us on notice, but they're rezoning the building for assisted living. So what does that tell you? That tells you they're going to kick us out as soon as they get the zoning through. Um, and they have to give us a 6-month notice. So, we're already ready. We've got a place to go just right up the road. So we're not going anywhere far. But, there's a lot of buildings around here that are in the same spot, and not just around here, around the whole country. And Atlanta is not one of the worst cities. San Francisco's, and other cities have a lot of empty real estate where when those leases are up, it's not going to be renewal time, and they're going to be empty. I mean, our building, for instance, they're planning on changing this into assisted living. So that is probably a good idea, but who knows how much it's going to cost them, and then who knows after all those changes, or if they're going to be able to make it profitable. But I'm sure in time they will. Finally, the other thing that we're starting to see is residential real estate. So if you read my last letter, cracks in the facade, that's where we're getting that. In Houston, in Austin, in Dallas, in Austin, for instance, the article was saying that 63% of homes that were $2 million or more have either had to reduce their price, or they've just had to remove the listing altogether because there's been no action, there's been no offers. So that's also happening down in Florida. It's happening in the Jacksonville area. It's starting to happen in Miami. Starting to happen down in the west coast of Florida. It's happening in Spokane, Washington. It's happening in Sandy Springs, Georgia. So we're seeing this starting to happen in certain pockets around the country where a lot of people move to after COVID, and especially in Texas and Florida. So that's starting. And if you just Google that, or go to YouTube and Google that, that's, search, Florida real estate or Texas real estate, or you can sort of see some of these trends that are starting to develop. And then finally, the thing that none of us are able to forget, just I don't think we can forget about it for an hour, right? Is the presidential cycle that's coming up. And I I don't know if you remember when Tom Price was running. Tom Price was our congressman, and he went to go work for Trump for the health committee of Secretary of Health, Human Services, or whatever. And so his seat was up for reelection, and it was just a major. It was at that time it was the most expensive election ever, and all of those dollars were spent ringing my phone. So what I did was I just had to cut off my phone, honestly, because it just was too much. And so that's kind of happening again, and everyone asks us, well, is this gonna change, the stock market? Is this gonna change long-term investing? Is this gonna change what you're looking at? Not really. I mean, we see it with these concerns that we have are still concerns. It doesn't matter who wins the election. And I just, we've got so much debt, um, and our deficit is so wide that I just don't see anybody able, doesn't matter who you are, I don't see anybody able to cut the deficit enough to make a difference. And our debt's just going to continue to skyrocket. And, some parties are better than other parties at spending money. And some parties have just no clue at all about, where this money comes from or what happens when you print a lot of money. But what happens is donuts are $14. That's what happens. Okay. If you haven't learned it by now, that's what you need to know. And not just donuts, everything else, everything else. We've looked at this every single way. I mean, which presidential party, which candidate. I mean, there's ups and there's downs in both. There's good policies and bad policies in both. And a lot of times the policies of one will affect the timing of another. So it's not really the one that's in office that's in credit that should get credit or should be blamed for what's currently happening. A great example of that is Bill Clinton when he had the surplus days. A lot of those surpluses came because of the Bush 1 tax cuts. I mean, I hate to tell you this, but that's the truth. Bush 1 made the tax cuts. He didn't get reelected. Remember, because he didn't say I won't raise taxes, and something happened, and then all of a sudden Clinton got elected, and then by the time Clinton came in, they had all these surplus, and it made Clinton's presidency look rosy. So don't be fooled by that. It doesn't matter. Again, there's the Clinton days, those are good days. And then the Bush 2 days were not good days. And so did Clinton cause the Bush down days? Probably. Did Bush one cause the Clinton up days? I think so. I mean, what about the Reagan days? Well, the Carter days, did Carter cause the good Reagan days? No, I don't know. So, it's too complex, and they're too intermixed, and they're interspersed that you can't break it down. Okay, so high interest rates, we talked about that, but that's going to be reprieve coming. But remember, even if interest rates do drop, back in 2008, they were dropping interest rates before the market crashed, and the market still crashed. So, I wrote a letter about that, and if you go to our website and look at the client letters, it's called Tail of the Dragon. So if you look at Tail of the Dragon, I compare the NASDAQ with the interest rates, and I can show you right there in that comparing those two charts where interest rates were coming down before the market ever started crashing, and it still crashed 50% almost. So high interest rates, corporate debt, one of the big problems with high interest rates, unwinding of the balance sheets, that's a good thing, remember, but it's $7 trillion that we have to remove from the economy. And it's like playing that where you're pulling things out, right? I mean, it's a house of cards. You're pulling money out of the economy. And when you have monetary reduction, nobody knows what happens, but sooner or later we have a credit event, and a credit event causes that lockup. And that's a lot like what we had on August 5th. So the leading indicators are still negative, every single one of them. The stock valuations are still overvalued, no matter how you slice it. Remember that? And then commercial office space is just nobody's talking about it, but I can tell you it's here. We go to offices around Atlanta and we can see them there. I talk to people from all over the country. I've talked to people from BlackRock that have, like 18 floors in San Francisco. They're going to give them all up but one. So, it's real. And there's some big players that are giving up a lot of lease space. And you can see that a lot of people, a lot of big corporations, UPS, Amazon, and others have laid off thousands and thousands of people. So those leading indicators are out there. So let me do this now. Go ahead and open it up for some questions. I love questions. And I was talking to Judy Seeger yesterday, and she said that she was typing a question last time, and I cut her off before she had the chance to finish her question. So I just want to make sure I have all those questions answered. So go ahead and ask your question. I'll go ahead and, for anybody out there, I know some of you are guests. I know some of you are not clients yet, but, sort of our claim to fame is to having this three-headed hydra here, where we have the legal team, the financial team, and the tax team. And it doesn't mean you have to have all your taxes done here, all your legal work done here, all your financial stuff done here, but we do like to coordinate those things. So by coordinating the legal framework, we can really plug a lot of gaps. And then by the tax team and the financial team coordinating together, I mean, the largest expense in investing isn't commissions or fees or anything else. It's taxes. Taxes will destroy you. And so, I mean, think about it. You're talking somewhere between 30 to 40% on every dollar that you earn in investments. I mean, that's a third of your investment right there. So taxes are huge. And if we can coordinate the taxes with the investing, then we can more than pay for ourselves, which we're very cognizant of. So I don't see any more questions. Judy, if you can push enter, everybody, if you have a question, push enter right now. Okay. The rest of you, we missed you at our lunch and learn yesterday, but we hope to see you at the next one. So please do come if you get a chance. And I thank you very much. As always, if you have any questions or any concerns, I'm here. Give me a call, shoot me an email. We have Blake and Mary and everybody else here. We work as a team, so we're all on your team. If we're not available, I have a 2-year-old, and so sometimes that takes me away, especially lately. He just started school, and we're experiencing now how there's new viruses and new colds and bugs, and that just seem to happen weekly. So I'm doing those. All right. Well, thank you very much, everybody. Appreciate it, and have a great day and a great weekend.